The ASEAN region is ripe for FDI investments, and we've seen this manifesting in the numbers over the course of the last few years. This is particularly true after the pandemic, where supply chain reconfiguration from China Plus One and friendshoring and offshoring policies have basically expedited the reconfiguration or the rearrangement of global supply chains. To that extent, FDI inflows into the ASEAN region have increased, and we've seen FDI inflows from the US particularly higher in 2023 versus 2022. Singapore has received the bulk of the investments in this region, but Indonesia, Malaysia, and Thailand are not too far behind. Similarly, we've seen some modest inflows into the Philippines as well. By sector, the large chunk of investments have gone into the manufacturing sector, along with some parts of investments going into the services sector, such as wholesale and retail trade, as well as financial intermediation. Starting off with Singapore specifically, while China is not the largest FDI investor by stock, it is increasing in FDI share over recent years. FDI investments from China into Singapore have become broad-based. They've varied across various sectors, including anecdotally things like digitalization, with Alibaba investing in Singapore, as well as in the manufacturing sector, as well as in the technology and the telecommunications sector, and various services sector, including financial intermediation. We expect that the relationship between Singapore and China will remain strong, boding well for future FDI investments. Similarly, in Indonesia, FDI inflows from China have increased quite substantially in recent years. However, they've been particularly concentrated on the mineral and the mining sectors, wherein the government of Indonesia has incentivized companies from across the world to invest and add value by creating onshore processing units. Chinese firms have basically invested in onshore refining capacity in Indonesia for minerals such as nickel, to help not only export refined nickel but also to supplement key supply chains for industries such as electric vehicles. Electric vehicles in Indonesia remains a key source of Chinese investments, and we expect that this will remain attractive over the medium term. However, there is a need to diversify beyond just the mineral and mining sectors into other sectors as well, and it will be key to see if President-elect Prabowo Subianto can manage to achieve a greater diversification. Specifically for Malaysia, while China is not the largest FDI investor, it played a key second place in 2022. In terms of FDI investments, a bulk of it from China into Malaysia were directed into the services sector, followed by the manufacturing sector. According to the American Enterprise Institute and the Heritage Foundation, it showed that a lot of the investments were targeted into the energy, transportation, as well as technology sectors. Going forward, we think that the pipeline for FDI investments from China into Malaysia remained quite strong. In April 2023, there were commitments of about 170 billion ringgit that were made, followed by commitments of about 200 billion ringgit in September 2023, when 19 MOUs were signed between the two countries. Moving on to Thailand, while Japan remains the top source of FDI inflows into the economy, inflows from mainland China and Hong Kong SAR have been increasing in recent years. A bulk of these investments have been directed into the electrical and electronics sector, as well as the minerals and mining sector and the auto sector. Specifically, there is an interest to try and bring Thailand into the new electric vehicle and the hybrid supply chain. BYD has recently expressed interest in opening a processing plant in Thailand. This shows that there is deeper interest to broaden and diversify the supply chain from China into Thailand, particularly into industries such as the auto industry. There is a deep connection between China and Thailand in terms of infrastructure and logistics. Thailand has been an integral part from the beginning of China's Belt and Road Initiative, and there are plans to continue to develop the Thailand-Laos-China railway, which will help increase connectivity between these countries. In Vietnam, although there was a rocky patch in terms of geopolitical tensions between Vietnam and China, things have smoothened out quite substantially in recent years, leading to much higher FDI inflows from China into Vietnam. This is positive in terms of the way the China Plus One policies have helped the Vietnamese economy. And according to officials, the nature of FDI inflows from China into Vietnam have changed quite substantially over the past decade, suggesting to us that they've become more broad-based. Overall, we see that there is a strong connection between China and ASEAN in terms of FDI flows. There is an impetus to continue to develop relationships between these countries, even though the nature of the flows into each country has been quite different over recent years. There is a sense that the ASEAN region complements China's manufacturing sectors and will continue to do so over the medium term. Finally, moving on to the other large economy in the South Asian region, India. India, similar to Indonesia, held an election in the early part of this year. For the Indian elections, however, the majority was not as resounding as in Indonesia. The election results were more mixed. We saw Prime Minister Modi getting a third term, but it was not without a reality check. The BJP, which is his party, lost the majority in the lower house and is forming a coalition with regional governments in order to stay in government. The focus for low-hanging fruits such as infrastructure as well as digitalization under the new government is likely to sustain, as well as the focus on fiscal consolidation. Overall, India's growth is likely to remain around the 7% handle over the medium term, which suggests that growth momentum is going to be strong. The progress on more difficult reforms may be slower given the fact that it's a coalition government and a lot of political capital will be expended on just bringing coalition partners on board. From RBI's standpoint, an easing cycle is likely to remain underway in the near term once inflationary pressures come down and the US Federal Reserve actually starts cutting interest rates. We expect the RBI to cut its policy rate by a cumulative 75 basis points starting from the fourth quarter of this year into the first half of next year. This suggests to us that RBI's easing cycle will be more calibrated than other regional peers. That said, there have been signs that RBI is turning more dovish and rate cuts could be as forthcoming as early as August. In terms of the fiscal stance, as we've already mentioned, we do expect the government to continue with fiscal consolidation and adopt low-hanging fruit in terms of infrastructure development. However, it remains to be seen the extent to which they can push through difficult reform. Overall, we still think India's path over the medium term remains attractive, and as an economy, it is going to do quite well compared to regional peers. However, it will not be without its own challenges.